Moving on with video 2, T accounts. In video 1, we reviewed assets equals liabilities plus owner's equity. We learned that debits are on the left in all cases. Credits are on the right. The only thing that changes is the rules of when it increases and decreases. For assets, debits increase on the left, and for liabilities and owner's equity, increases on the right. Also in this video, we'll take a look at these other accounts. Paid in capital, retained earnings, revenues, expenses, and dividends. We'll also look at an account called the drawing account or withdrawals and learn the rules for those classifications of accounts. And then once again, we'll practice using quizzes. So we left off here with your worksheet. Assets, liabilities, owner's equity. Now we're going to move on and take a look at the rules for revenue, expenses, capital, withdrawals, dividends, and retained earnings. So revenue, as you know, when we sell something or sell farm products, it's an increase in sales, and we record that in a revenue account. And an increase to a revenue account is a credit. So we'll put the increase there. For expenses, expenses increase with a debit. And capital, it's an owner's equity account, it will increase with a credit. Withdrawals account. So this is when an owner withdraws assets out of the business, whether that be cash or equipment. Anytime there is a withdrawal of some assets of the company, that is recorded as a debit. So an increase in the amount that is withdrawn from a company. Paid out dividends increases with a debit. And retained earnings increases with a credit. It's another owner's equity account. Let's talk about these two real quickly. So retained earnings is the record of all the earnings of the corporation over the life of that business. And the dividends are the paying out of the retained earnings. In fact, let's take a look. I have an image here. There we go. The normal balance in the retained earnings account is a credit. This balance signifies that a business has generated an aggregate profit over its life. The historical amount, it's the total amount that's been earned over the lifetime of the corporation. However, the amount of retained earnings balance could be low even for a financially healthy company because the dividends are paid out of this account. So just keep that in mind. Retained earnings like historical record of all that's been earned by the business, but it doesn't mean that there's going to be a huge balance or that it's some cash balance of amount of money that's sitting around waiting to be spent. It's just a record of what's been retained by the business and not paid out in dividends. Let's take a look at dividends here. For dividends, it would be an equity account but have a normal debit balance, meaning the debit will increase, credit will decrease. So you increase it with a debit because the effect is to decrease the normal balance of the retained earnings account. Let's now take a little more detailed look at why revenues increase with a credit, expenses increase with a debit, and then also why these rules apply for withdrawals, dividends, and retained earnings. So what I've done here is I have a large T account for owner's equity. So you can see this is one giant T account for owner's equity. And sometimes this is described in terms of the capital account. And capital being an owner's equity account, but is a specific account for the paid in amounts for capital, as we had looked at very briefly on this page here. Paid in capital, there it is right there. So paid in capital, or just capital, represents the owner's investment in a business, and that is classified as an owner's equity account. And a corporation might be called a stockholder's equity account. paid-in capital. So let's take a look at these rules and see why this makes sense as far as debits and credits go. I'll zoom in a little bit more on this. So what I've done is that I have a T account, and then I put smaller T accounts on the normal balance side of the owner's equity account. So we have this large T for owner's equity, and then I put these smaller T accounts in based on the normal balance for that account. For example, the normal balance for revenue is a credit. So I've put it on the right side of this owner's equity account. So I have a little t within the big T, but I've placed it on the normal balance side for this classification of account. The normal balance for retained earnings is a credit, so I've put it on the credit side of the giant owner's equity T account. And likewise over here. On the left side, the debit side, the normal balance of an expense is a debit. Therefore, I've placed the T account on the left side of the owner's equity T account, just to indicate that expenses increase with a debit, withdrawals increase with a debit, and dividends also increase with a debit. Let's see why this makes sense. First of all, it's pretty easy to understand the revenue situation here, because if we sell something, we pretty much have learned that we're going to record that increase with a credit, and it just makes sense is that if we sell something, our business is going to get larger. An increase in sales means we have more capital. So that's going to increase there on that credit side. Retained earnings increases on the credit side. Paid-in capital, investment by the owner, increases on the credit side. Think of it this way. If you were to start a business, let's say you buy Ross Market, and you have a personal savings account, and you take that personal savings and invest it into buying that business, or you invest it into that business to, for some reason, you need to buy some equipment or do something in order to help Ross Market grow. That is paid-in capital, and you would record that as a credit. Now let's come over and look at expenses. What do expenses do to a business? They decrease the size of the business. They take away from the amount of capital available. Therefore, it makes sense that if you increase your expenses, overall you will decrease the amount of equity that you have in that business. More expenses means less equity. Less equity is recorded with a debit. Therefore, an increase in expenses has the effect of decreasing owner's equity. Therefore, we have to increase expenses with a debit. Let's go through that again. Owner's equity is decreased with debits. If we increase our expenses, we will have less owner's equity. Therefore, we have to increase expenses with a debit. I believe I had mentioned previously that another way to think of expenses is think of them as like temporary assets, like electricity. You have it for a little while, but it's consumed almost immediately. So the other thing to think of is expenses are those things that are consumed in order to keep the business running. Just like that fuel in your automobile, the gasoline gets consumed to keep the car running. Expenses are necessary in order to keep the business running. But overall, they decrease the amount of equity that we have in the business. And of course, if we have too many expenses and they exceed the revenues coming in, we get into that negative income situation, and that is not healthy for the business. You need to have more coming in than is going out in order to have net income. If it continues, eventually we can't pay our bills, and then of course we have bankruptcy and go out of business. And withdrawals, once again, same concept. If you take something out of the business, you have less equity, and so an increase in withdrawals will decrease the size of the business. That happens through a debit. Therefore, an increase to withdrawals is recorded as a debit. More withdrawals, less equity. Dividends, if you pay out of the retained earnings, the earnings of the company, you distribute those to the stockholders. In the case of a cooperative, they call those patronage dividends. And so an increase in the amount that's distributed to owners is a debit. And so hopefully that helps out a little bit. And once again, we'll head over to quizzes and practice these rules of debits and credits.